Hey, good afternoon. My name is Michael Mogavero. Been with Lake Mason for about 3 or 4 months now. A little bit of background about myself. Prior to this, I was a financial advisor at Merrill Lynch, a sole practitioner as well as on a team. So I understand, the difficulties that come with being an advisor. Also, as an advisor, I've seen numerous wholesalers come through. Some better than others. I've always found that the most talented wholesalers are the ones that understood it's not always just about the product and the performance of the product, but more so about providing a solution for an advisor who in turn can provide that solution to their clients. Everybody's got a good performing fund. What are you doing to sort of separate yourself? So it's my hope today that when I share with you a couple ideas from my firm, that perhaps we can better position some of your clients for the current environment that we're in. So as far as the current environment, from a fixed income perspective, difficult investing environment. I don't think anyone would argue that. Basically, we've been on a bull run in the fixed income market for the last 35 years. Most firms, thought leadership, are predicting that rates will eventually rise. They've been doing that for quite some time, and it's yet to come to fruition. So if the fixed income market has told us anything over the last few years, it showed us that we can throw basically all conventional wisdom out the window, and trying to time that rate increase, it's going to be nearly impossible. Obviously, valuations and predominantly all aspects of the fixed income market here domestically are a little bit frothy, but there are plenty of other opportunities out there, whether it be overseas or in a little bit off the beaten path, if you will, right? So the question becomes, we know rates are going to rise eventually. We know that will have a detrimental effect on clients' fixed income portfolios. What are we doing to position client portfolios in preparation for the rising rates? And what are we doing to take advantages of those aforementioned opportunities that are a little bit off the beaten path? So you may have heard a lot of talk about unconstrained fixed income or unconstrained bond funds. I want to talk to you a little bit about that today. So at Leg, we tried to make it a little bit easier for you and bucket unconstrained bond funds into two separate spaces, if you will. So the first is opportunistic. These are the funds that are obviously benchmark agnostic. Look at them as providing the alpha for your fixed income portfolio. The other bucket is core diversifiers. These are the type of funds that are going to diversify risk, provide you with bond-like returns, but also do it with bond-like volatility. First two funds I'm going to speak about fall into the opportunistic basket. The first is our Brandywine Alternative Credit Fund. It's a global credit fund. It's a concentrated portfolio of high conviction ideas. I think the key point to this fund is its low correlation to the 10-year. It's actually slightly negative. Very low correlation to the S&P 500 and very low correlation to the Barclays Agg. From a performance perspective, it is actually the number one fund in the space on a 1 and 3 year basis as per Lipper. Second fund I want to talk about is our Western Asset Macro Opportunities Fund. So this is a global macro strategy. Basically what they do in this fund is focus on long-term value investing with active management of duration, yield curve, volatility, and currency. It's a total return play. Essentially what they'll do is focus on 3 to 5 long-term macro themes, and then they'll have a couple short-term themes in there, predominantly taking advantage of those through interest rate trading. Again, a correlation story. So virtually no correlation to the S&P. Barclays Agg duration is fairly low at 1.7. So when I look at both of these funds, as I mentioned, they're falling in the opportunistic bucket. I think, how am I going to position them in clients' portfolios? Are these going to be a replacement to a core holding? No. I would look at these more as a satellite to your core holding. So depending upon the client's risk tolerance, I would allocate a higher amount to these funds as, again, a satellite to a core holding as a client's risk tolerance increases. I think these funds are a good way to increase the alpha of a core fixed income holding, and obviously provide some type of hedge in a rising rate environment. So second bucket I mentioned, core diversifiers. I have two funds that fall into that space as well. One is going to once again be from our affiliate Brandywine. It's our Legg Mason Brandywine Absolute Return Fund. What is this fund? It's a global long-short fund. Has a mandate to invest across all countries, currencies, and credits. So basically what they do is they use active currency management to either enhance returns or protect some of their returns. The goal of the fund is to outperform the 3-month T-bill by 300 basis points over a 36-month period. Actually, it's done that. If you take a look at any rolling 36-month period since the fund's inception, they've been successful in outperforming that benchmark. Lots of flexibility and duration, -5 to 5 they can go to. Once again, see a common theme here, little correlation to anything else, whether it's the AG, S&P 500, WGBI, so on and so forth. Finally, fourth fund I want to discuss is once again from our Western Asset affiliate. It's our Total Return Unconstrained Fund. So out of all the unconstrained funds in the space, this actually is going to have the longest track record. I think the key to this fund is that it's not managed to a benchmark like the others. However, this one is managed to a vol target, roughly 3 to 5. Again, flexibility in duration, flexibility in where they position on the curve, flexibility in sector, flexibility in credit quality. This type of fund, a little bit different than your alpha generators. It's going to live in the second quartile, not going to hit a home run like your opportunistic funds, but it's also not going to strike out. So I think with the two funds that fall into our core diversifier, you're going to want to position these in clients' portfolios as an actual core holding or as a complement to a core holding. Obviously, there are risks that come with core holdings. Core holdings need to adhere to a benchmark. These funds will have a similar risk-return profile as your core holdings, but the inherent flexibility in these funds that your core holdings don't have will allow them to better position themselves in any kind of fixed income environment, particularly in a rising rate environment, which we foresee. So all these funds are very different in strategy and approach and how they invest, but they're also very similar, right? So we're looking to protect clients' fixed income portfolios in an eventual rising rate environment. The low correlations of the four funds to the traditional asset classes and this flexibility within the funds to manage that duration and move around different areas of the fixed income outside of the typical domestic market that we're used to, I think is a fantastic way to, one, generate that alpha on the fixed income side, but more importantly, to help hedge against any kind of rising rate environment that we're currently or foreseeing. So if we're looking to take advantage of opportunities in the fixed income markets, again, I think that these funds provide an interesting way to, again, look offshore and help mitigate some interest rate risk. So if you have any questions, I'll be around. Thank you so much.